All right, guys. Hey, welcome back to the Financial Beast podcast. I'm, of course, your BFFF, your best financial friend forever, Eric Miller. And hey, it's March 6th. Can you believe it? And in honor of it being March 6th, and I think we all know what's right around the corner, which is tax time, I wanted to bring on someone that was a specialist, not just in tax preparation, but actually in tax planning, because one of the biggest gripes that we get from a lot of practice owners is the lack of tax planning that seems to be done by their team. So I wanted to bring on someone that I've known for a bit, that respect his opinion, his viewpoints, and we'll get into some pretty cool questions and everything related to taxes. And making sure that this area is an area that you guys have some control over. So here we go, Mark Martekovich of Business Advisory Group. And what was the last part of that again, Mark?
Business Advisory and Accounting Partners.
There you go. Located here in Clearwater, Florida.
Yes, sir.
So, all right, man. Well, let's dig into it. And I think one of the first things I want to talk about is because you have a lot of practice owners as clients. I mean, so you're in the healthcare space. I know you do other things, but you have some healthcare practice owners. And one of the things that seems to be, I don't know, a problem is the frequency of how often someone meets with their CPA and accounting team. And I guess I just want to get it from your perspective of what do you think that frequency should be? Because some people are just it's once a year and that's it.
Yeah.
And
so I'll tell you that's not the answer, right?
Thank you very much. I'm right. All right.
Yes, you are.
Because it's and I'm just look, man, your financial situation's fluid. I mean, you got to make decisions, especially if you own a business, every single day. And I just can't imagine all right, we'll just meet once a year and we're going to solve I'm going to have a list of questions a mile long. So what's your take on that?
Well, and Eric, typically what clients will do or practice owners will do is they'll meet this time of year when it's already after the end of the year. Okay. And they're bringing their list of questions of things they should have done. Right. And they've got all their information and they want the accountant to just kind of magically put it all together and do the tax return. So, we recommend that business owners especially meet with their tax advisors a minimum of once a year, but not during the tax drop-off. That meeting should occur before the end of the year. Typically, we schedule those meetings between October 15th and December 15th because there's a lot of things that we've talked about maybe throughout the year that we want to make sure get in place before the calendar year flips. And so at a minimum, it should be one time beyond that tax drop-off. Now, I do highly recommend meeting once or twice a year, especially if you have, like you said, a very fluid situation. It's important that you get ahead of, what's going on in your business, how much money and profit is being generated in that business, because that's going to have an impact on your tax return. So waiting until March or April or this time of year is not good. Sometimes waiting till December may not be the best. So we do recommend maybe a mid-year meeting where at least you're touching base, kind of seeing how things are tracking, doing some projections. And that way you can react to things that are going on in the business and not be surprised at the end of the year when the tax return is done. So a couple times a year, I think is very important.
Especially if you're growing. And, I think that's one of the what we'll see is, a practice that's growing, and then they get, of course, somewhat shocked when they start looking at how much quote unquote profit they actually have and what they're going to owe in taxes. So,
and I think
we'll get into that in the whole surprise. Yeah. The whole surprise tax bill thing, which is completely unnecessary.
Well, and I think a lot of the frequency of the meeting you have with your tax professional or your tax planner depends on how well you know your numbers too, right? So if you don't know your numbers, you should probably be meeting more frequently so that you can, get some education around what they mean. But if you have a good handle on that, then maybe it's less important to meet as often. And the one thing that's important to know is these meetings with your tax professionals probably are not part of what they do just to prepare your taxes. It's part of the whole tax planning process. And so it goes beyond them just filling out a lot of forms for you and getting the tax compliance work done. It involves some planning and getting ahead of the game, like you said.
And maybe just define that for people, because I mean, as much as I try to say it, there's a difference between tax preparation and tax planning. Like, how would you differentiate the two?
Yeah, so a tax preparer, somebody that just does tax returns or that just knocks out that 1040 work or the 1120s or so on and so forth, is really reactive. Okay, they're not doing any planning. They're just taking information that you have, in your accounting system or whatever numbers you have, and putting them in a form and completing that task. A tax preparer is somebody that helps you interpret the numbers, helps you manage the numbers and get ahead of the game. And so, essentially you're managing your outcome when you're working with a tax planner. And with a tax preparer, you're just kind of reacting to it and then just moving on and dealing with it. So there's the huge difference. The tax planner is somebody that you view that you should view as an investment. That relationship you have with the tax planner is an investment in your financial well-being and in your kind of wealth building process. A tax preparer is really just an expense. It's somebody you're writing a check to get something done, and you're not really kind of doing much in the way of planning when you have that kind of a relationship with the person. So very important that you have somebody that knows and understands how to help you be tax efficient.
Yes, for sure. Um, uh, so another question that we'll get quite a bit is how do I know if my CPA is doing a good job for me or not? This is kind of a tough question. I don't, because
kind of puts me on
the
spot,
there's
right?
probably more things than just a little bit. That's okay. Well, look, I mean, most of the practice owners that we deal with understand like metrics. Okay, I have metrics I have to follow. And in my business, how many new patients have I had? What's my average transaction and all these different things. So, I don't think it's unreasonable to assume that if I'm going to hire a financial team, like everybody has to have certain metrics that they have, like a stat, okay, that will at least give me some representation of how I'm doing, and what direction I'm, or what kind of quality of advice that I'm getting.
Sure.
So what would you like? Do you have a couple, and maybe that's not even a metric. Maybe it's just like a relationship dialogue as well, because I think that also is part of it too. I mean, here's what we usually get. Every time I go see my CPA, I come out and I have 1,000 misunderstood words because I have no idea what they just said to me. I'm like, that's a bad relationship. You don't want anybody talking over your head. So do you have any insight on that? I'm sure you do.
Yeah, I do. And you frame it accurately, Eric. It should be a relationship. Okay. And, ironically, the metrics that we use to measure the effectiveness of a CPA relationship or an accounting relationship aren't all empirical. Okay, so it's not all about the numbers. A good
Right.
relationship with your tax planner or tax advisor should produce some tax savings, right? Okay, you should not pay more than you need to or more than your fair share of taxes. And we study all the laws and the changes and things like that help you become tax efficient and not pay more than you need to. And unfortunately, as business owners, the odds are stacked against you with the way the tax laws are written. So it's our job as professionals to know and understand how we get that advantage back on your side and put more money in your pocket. So that's one thing. So tax savings is a small part of the overall kind of evaluation of the performance of your CPA. And realistically, we don't always have this magic bullet that saves you a ton of money. Now, there are certain things we can do that will save you things, but we're not always going to have big tax savings. I think some of the more important measures are obviously accuracy. They got to be able to produce good work and get the numbers right. And that's important. Make sure the tax returns are right. They should be. But timeliness, effective communication, and you hit it right on the head. Walking out of a meeting with the CPA should not leave your head foggy and fuzzy, right? You should have a clear understanding of what they're trying to communicate to you. And I pride myself, and my firm prides ourselves on being effective communicators in plain English. Okay, we can all speak accountant speak as CPAs and tax practitioners, but that doesn't do the average business owner any bit of good if they don't understand what the heck we're talking about, right? So we pride ourselves on being able to communicate to you in a way that you can understand what's important in managing your numbers and managing your business and kind of doing the things you need to do, which levers you need to push and pull to get the right outcome. So communication is so important. Another key piece is being proactive. Okay. When's the last time your accountant came to you with an idea about how to save? Or does that relationship look like, hey, I read this or heard this about, from my colleagues that said, oh, they're doing this. Why aren't we doing this? We get that a lot when there are new prospects coming to us. And the idea is we study this stuff. We know these things, and we should be bringing you those opportunities and ideas because we know you as a client, and we know your business, and we know the things that you encounter in your everyday business, and we should be looking at those things and say, okay, this situation should apply to this practice, and let's talk about whether or not it makes sense. And so being proactive with those things that could help you manage your situation are key. And then of course, I always try to tell people you should think of our relationship as an investment. We should be providing some sort of value to you in your wealth building process, not just your tax savings process. Because to me, a good outcome is you as a business owner viewing your business as an investment and building wealth, not just saving and paying the least amount of tax. So there should be some value in what we bring to the table when we talk to you about things that you can do for your business. Those are the most important things that you should use to gauge the relationship you have with your CPA. Is that relationship more you asking questions, waiting for answers that you may or may not ever get, and then not understanding the answer? Or should it be, hey, we have a good conversation, they're part of our team, they're helping us, get better outcomes and manage what we do. And again, building wealth is the key. Use that business as an investment so that you can have a good positive outcome.
I'm not going to BS you. That was one of the best answers on what you should expect from a CPA that I've ever heard, man. I'm serious.
Well, thank you.
I wrote every single one of those down. That was awesome.
Well, we have it on tape too, so we could always go back to it, right?
Yeah, I was going to say, I want to go back and cover my notes, but this is one of these things where people always, as a financial advisor, of course, we seem to be just like, okay, let me just look at your effective tax rate. Because that seems to me like that is the measurement for of how your tax team is doing. But that's not really the case because, there could be a number of things that would have an impact on that effective tax rate. You could, be growing exponentially. You could, who knows, right? So, I think all these other things certainly have are of equal of importance as that. Because it really does kind of get down to like what the nitty gritty is of the relationship and what you should expect out of them. That was excellent, man. I love that.
And that's why we like working with your team because, we're in sync with what we're trying to do for our clients. You're trying to build and manage the wealth that they can produce. And we're also trying to do that. And we're trying to do it in such a way that it's tax efficient and giving them more opportunity for you to do some things with them. And so I love the relationship that we have. Yeah,
because we'll get that quite a bit. One of one of the things that we tell a lot of our clients is, hey, look, we have to make sure that the business profits are being utilized, not obviously just to increase the value of the business, but we want you to pull out some of that so you can create other income sources outside of the practice. And,
Yep.
It seems to make perfect sense to me. I don't want them to be reliant upon the business for the rest of their lives, have real estate, have, other stocks, bonds, whatever it would be. And sometimes my accountant said that if I do that, it's good to do this. And I'm like, okay, great. But I need someone that sees the bigger picture, not just trying to just focus on just the tax issue and look at all the other things that we're trying to do. And I think that's when you have a CPA that gets that, like, okay, I get what you're trying to do here. Let's try to do it in the most efficient manner possible. That to us is really important. And unfortunately, a lot of CPA, we have people that just leave tons of money in the business, and it's just, it's interesting to watch. Yeah. You deal much with, I want to talk a little bit about because there's all this, there's going to be 80,000 new, IRS agents
coming after us, right?
And everyone that makes are coming after us, and like the Gestapo, and then we're gonna, everyone's going to be audited. And I'm not saying that there wouldn't be the increase of audits. I guess a couple questions is that, should people be that afraid of getting audited? And number two, what actually happens during an audit? Yeah. I've always kind of been curious about, because I have not been through one. My partner has, but I have not. So I'm assuming at some point in time, probabilities are I may, but what is that experience like as someone that I'm sure has had clients that have been through them?
Yeah. Well, the beauty of it is the level of audits is still very, very low. And even with them increasing their efforts, they're looking for specific things, and they're looking for people that are maybe, doing things that are not above board. Audits are not a big deal. Okay. It just sounds intimidating. The key is if you're doing everything right and you can defend the numbers that you put forth in a tax return, there's never a problem with an audit. It's just a matter of kind of going through the mechanics of getting it done. And, they've got questions. They see things that might be red flags or territory where there may be some kind of questionable activity. But the reality is, I don't fear audits as a firm, because we advise our clients to do the right thing. And, we work with business owners to make sure that they know and understand what's ordinary and necessary as a deduction in your business. And, yes, there are certain gray areas and areas where you can get a little more aggressive, but not go over the line. And so, I always tell my clients, number one, I'm not going to jeopardize the license that's on the wall, okay, for anybody, but we're going to give you good advice, and we're going to give you, tell you what the opportunities are, and let you know what the risks might be with certain strategies we would employ. But at the end of the day, I need to be comfortable sitting across the table from an IRS examiner and explaining the numbers that I put on a tax return for a business owner. Okay. And when I'm comfortable with that, doesn't matter what happens in an audit. It's more of a process than anything. And so when you talk about the audit process, it's really just kind of a review of an individual's kind of accounts and make sure that they're doing things the way they're supposed to be. There are random audits. So you could be doing everything right and everything's rosy. But you might get that random audit that comes. Okay, so no big deal. You go through the process. Or, there may be certain strategies that get more scrutiny than others, and they may, be audited more frequently. And that's okay too, again, as long as you're doing things that are above board. But when an audit happens, typically you get a notification. It won't be by phone and it won't be by email. It'll be a letter. Okay, there'll be a letter. The IRS won't call you, and there's lots of scams out there you got to be careful of. But you'll get a notification that says, okay, we need to look at this, and here's the tax year, here's the information that we want, and then you provide it. And so you take that to your tax advisor, and then we gather the information. So we prepare all the information to give them what they're looking for. You don't don't necessarily want to give them everything, right? You just want to give them what they're looking for. And there's three different types of audits that typically happen. So there's what's called a correspondence audit. That's when it's just a letter, sending you, hey, when you want clarification on this, send us this documentation, you're done. There's an office audit. And that may be, hey, you've got to come down to the IRS audit office and bring us this information about this. And then you meet with an examiner right there. And then there's what's called a field audit. That's where they would come out to your location. Typically that's done when you have maybe inventory or operations that they want to see and kind of look at. And so that's pretty comprehensive. Doesn't happen a lot, not a big deal. So when the audit happens, you have a meeting with the auditor, you kind of go over what they're looking for. They ask you some questions, you provide information, and then they take it back and do their thing, and they come back with their findings. And those findings could be no change, which happens quite a bit. When we've dealt with audits, the few that we've done, a lot of times it's no change because they agree with what we have. We provided substantial documentation for them, and they're comfortable with it. They may agree with everything, and then there's the disagree. And then when you have the disagree, then probably some penalties and interest and things like that, and you just got to pay some taxes and so on and so forth. So it's not really a big deal. And then if you're ever in an audit situation where they come back and you don't agree with their findings, they have an appeal process, and you can go through the appeal process and go through it. And it's, again, not a big deal. It just takes time. The most important thing, again, is if your tax preparer and your tax planner are doing things that are above board, and they've got substantial documentation and it's very defendable, you don't have to fear an audit. So it's not a big deal.
Okay. That makes sense. I always kind of figured that, it's one of those things where as long as you keep good documentation, you should feel good about your chances of being able to sit across from someone and say, okay, this is why we did this. And
one of the other things that's important is, we tell people you don't want to commingle business and personal funds as much as possible. Okay. So we always advise our clients, when you have businesses, set up a separate business account. Don't run your personal expenses through it. If you have expenses that are maybe personal in nature or can be combined, make sure you're reimbursing and have a good paper trail of stuff going back, because you don't want the IRS digging into your personal accounts. And so you don't want to be running business expenses through that. Just when you have an audit, just have everything that's on the business side, they stay out of your personal side, and everything's good. So good practice is to just not commingle the funds.
Yeah. Do you have some examples of where people get a little over the line on the personal, like running personal expenses through the business? Anything specific?
Yeah. So yes, clothing. A lot of times, clothing is. Clothing is, a lot of times people will buy stuff and say, "Oh yeah, I need it for work," and it's this is a business expense. Well, it's not unless it's logoed, so that's a big one. A lot of meals and entertainment type expenses. People say, "Oh yeah, I had a meal with my spouse. We talked about business." That may not be something that's really deductible. Sometimes people will get aggressive with home office type deductions. They're trying to deduct a big percentage of their house when they really shouldn't. The reality is, when you have home office, it's typically 8 to 10% of your living space, so it should be 8 to 10% of your expenses. But I've seen people get aggressive and say, "Oh yeah, it's 75% of my house is being used," and they claim big numbers on that. The reality is, it's not worth being that aggressive on some of these things. And the personal stuff, car payments are another one. Sometimes people have their car payments paid through the business.
Tell me about that, because that's a pretty big one that I'll get all the time. That people will ask me, and I've never done that. I've never paid a car through the business, just because I was always told that I couldn't do it. And so where is the line on that? And when can you do it, and when can you do it?
Yeah. So the key is, if you have a vehicle that you use both personally and for the business, you can deduct the business use as long as you track the mileage. The most important thing is track your mileage, and that mileage establishes a proration of how much you use your business. And so you can deduct, your miles times the standard rate and get a number that you can deduct. Or if you want to take actual expenses and you want to take your gas and repairs and lease payments and so on and so forth, you can take and get a proration of that and get yourself reimbursed for those expenses. So, mileage or mileage expenses or auto expenses are really commonly misunderstood and most frequently abused, because people just say, "I'm going to pay my car payment," and they don't do it the right way. if you own your business, or if you own a vehicle and you use it in business, from a protection standpoint, it's always better not to title it in the business name, because you could have some issues if you're in an accident. So always better to insulate it and have it owned personally. But if you use it for business, don't be afraid to deduct the business expenses if you can document and substantiate it. So there's a whole kind of laundry list of what we do, and we actually have a little bit of a white paper that we're happy to share, and I'll share with you, Eric, as well, that you can give to your clients, that talks about what you can deduct, how you should do it, and how you should kind of substantiate the things. A lot of times people will try to estimate on miles. Don't do that. If you want to deduct your auto expenses, you have to track the miles and keep a good log of it. If you don't, you're not going to get the deduction, because it's one of the first things in an audit that they're going to ask for. So there are, but there, certainly a lot of times where you'll use your vehicle for a business purpose. So why not take the deduction? So it can be done.
Yeah, for sure. But business use does not include the commute. Correct?
That's correct. So that's right. The IRS lets you take mileage as you drive from one location to another in a business setting. So they don't allow you to take that drive into the office. One of the things that's most frequently done for people that can substantiate it is if you have a home office, your commute is to walk down the hall to your home office, and then that drive from your home office to a business location can be deductible under certain circumstances. So you just got to do it the right way, and knowing how to do it and substantiating it can get you a bit of a deduction for that, as long as you can establish a home office. And in today's environment, many of us have a home office, right? A lot of us work from home. We do administrative work as a practice owner. You may not be able to do your administrative work in the practice because you're dealing with things that are going on in practice. And there's some things that might be sensitive that you don't want to do in the office. So if you have an administrative home office, you might be able to do some things with deducting mileage from your home to that office, if done in the right way.
Okay. So if I'm doing I do Zoom meetings and those things from my home office, just because it's quiet, or it's, it's time, so that actually I could, qualify for a home office deduction for those activities. Okay. And then at the same time, I guess I could then justify using the car for as a business deduction as well.
That's correct.
Okay. Yeah.
And the nice thing about that, with mileage expenses, that's something that we can decide which is more advantageous to you at the end of the year, because you can take your miles driven times whatever the standard mileage rate is, or you can take actual expenses times the proration of how much you use it, business versus personal. And so we get some choices on that one, and we can take whichever is most beneficial to you the first year you do it. And then after that, we've got some rules we have to follow. But yeah, definitely, I would not avoid it. Okay, because it's pretty common in today's environment to have a home office and to be able to have some deductions for some of those miles that used to be commuting miles.
Yeah, oh, that's great. Hey, I know we kind of touched on this with the surprise tax bill, because come April, I can guarantee you right now we're going to get at least 5 people call us. They're going to say, Eric, my accountant just called me up and said that congratulations, you had a great year. You owe $75,000 in taxes.
Yeah.
And I'm always, and I think we kind of touched on this earlier. I just don't see any reason why that should occur. I think to your point, if you're meeting frequently, that's why you encourage the timing of having a meeting prior to the quote unquote drop off, right?
Yeah, and 100% agree with you, Eric. That's something that you should be able to get ahead of. Okay, if you're meeting with your advisor on a regular basis, typically when we meet with a client mid-year, we're going to do a projection of how they're tracking. We're going to ask them what they think the revenue is going to be. We're going to get their numbers up to that point, and then we'll do a forecast and say, okay, here's your exposure for taxes based on the income, and then maybe we need to for some moves that we can make. And then again, at the end of the year, when we do our tax planning meeting in that October to December timeframe, again, we're going to do a projection. And at that point, you're going to know what the tax return is going to look like based on all the information we have to date. So the only thing that could change, that could produce a surprise, is if you kill it in the last 2 months and you didn't expect it, or the last month, or whatever that is,
right?
Or something significantly changed. But the idea is, if you're meeting with your tax advisor regularly, you should be planning for it. And one of the concepts I try to tell people is, I want you to pay for this year's taxes with this year's income. And what that means is, we know what the income is, we know what your tax bracket's going to be and what your situation's going to be. Here's your number, okay? I want you to start setting aside money for this and paying for it, either through additional withholdings from your paycheck or quarterly estimated payments. And that way, when it comes time for us to give you the tax return that we prepare at the deadline, you know what's going on, and there's not that surprise. I don't like surprises, and my clients should not be surprised by that. And when somebody's having a good year, you kind of know it during the year that it's a good year, right? It's not like it's a surprise to you that you made a bunch of money in a year. So the tax component of it is certainly something that you can get ahead of, and certainly something you can plan for. And then again, maybe you can make some moves that can, drop that number down a little bit. But without knowing any of that stuff and without meeting with your advisor, you're going to have those surprises, and it's not going to be pleasant.
Yeah, it would seem to be pretty simple. I mean, if you give a projection of like, hey, look, you're probably going to have like $100,000 tax bill this year. You're going to owe $100,000 in taxes, right? And just, okay, great. So I know that's $8,000 a month. I mean, that's how much I'm probably going to need to set aside. I have a tax account where I put that money, every single month, and then it's my tax team's job and my job to see if we can whittle that number down.
Absolutely.
So that maybe I don't owe all of it at some point in time, but at least I am being proactive in separating the money out. So it's because it's predictable. I mean, we're going to have to pay taxes. I mean, that's pretty predictable expense. So just like any other quote unquote expense that you have, I just encourage everyone just to have a tax account and just start putting money in there. And then that way it's not a problem. It kind of forces you to make sure the business is operating in a solvent manner. There's the necessity level of, okay, I mean, I need to cover all these things. It's not just, paying the business expenses. I mean, the business gives me a personal tax liability. So I got to make sure that we're accounting for all that. So
it's almost like a cost of sale.
It should be just
right?
that simple.
Yeah.
It should just be that simple, but that's really good. Any other like tax deductions for practice owners that you've seen that are kind of overlooked? I think the common deductions that I think people will usually hear from their CPAs are just load up on your retirement plans and or buy stuff at the end of the year. That's the cookie cutter advice, I guess. Anything?
Yeah, and the whole thing about buy stuff at the end of the year. You don't want to buy something just to get a tax deduction. Okay. So if you spend $100,000 on something to get a $22,000 deduction, you still spent $100,000, right? So it's got to be something that makes sense for the business. Okay. Right. I'd almost rather keep the money and give it to you, Eric, and do something with it and have me make more money than necessarily spend for something that I don't need. But when you talk about things that are often overlooked, and when we get new clients coming on board, sometimes I'm amazed at some of the things that I see that are missing from deductions. One, we talked about it briefly, the home office deduction. Again, that's one that's pretty prevalent now because so many of us are working in a home situation. So that one's often missed, often misunderstood. People used to consider it a red flag. It's not a red flag because the IRS several years ago put a simplified method of calculating it right on the forms. So they know and acknowledge that it's something that's commonplace. And And so that's one that people just don't understand how to use and use effectively. And then obviously we talked about it too, the combination of with the mileage deduction. So not doing that
Mm-hmm.
properly. For practice owners, some of the things I see that are missed frequently is sometimes people don't really understand that they can deduct costs of education and training. Many of us have ongoing continuing education requirements, and so that's deductible. It's helping you kind of stay up to date with things that are going on in your practice or in your business, and so those things are often missed, surprisingly, and something that can be deductible. Obviously, equipment deductions. There's things you can do with that, and there's some
Mm-hmm.
nice kind of bonuses that you can take when you buy equipment that can give you a deduction if you need it. So it's kind of the fast, easy hit conversation, and it's one that a lot of people just gravitate toward. Another one that really surprises me, sometimes people don't really realize they can deduct health insurance premiums for themselves in a business. And believe it or not,
Mm-hmm.
it happens, and it does. And that is a deductible business expense, and so sometimes that's often missed. And even we see it in older practitioners or in older business owners when they pay Medicare premiums. Sometimes they think, oh, Medicare, they don't even think about it. That's something that you can deduct as a business expense, much like you would be deducting group health for somebody that's not on Medicare. So we see that a lot. And you touched on retirement contributions. Lots of cool stuff we could do
Mm-hmm.
with retirement plans, and that's where we love to get your
Yeah.
group involved, because you can supercharge some of that if it's the right situation for you. Sometimes putting
Yeah.
money in a lockbox like that isn't the best thing, but if it's important to you, certainly there are some nice accelerations we can do on different retirement plans beyond just the basic IRAs and 401ks, and your team's really good with that kind of stuff. Other than that, insurances sometimes get missed. Travel for medical conferences,
Mm-hmm.
that a lot of times
Yep.
gets missed, and things like that. So those are some of the things. The thing that we do when we bring on new clients, we take a really deep dive into everything that they're putting through the business, and we're
Yeah.
looking for all these types of things that might be missed that we know apply to a medical practice, and so on and so forth. So when you have somebody that's got some knowledge of your industry, it's important to kind of pick their brain and let them kind of dig in and see what things might be out there that we could still do, or we could do in addition to what's being done.
Yeah, because if you've seen, a healthcare practice owner, you see their financials, and you see a lot of them. Obviously, you can see what people are doing, and it allows you to impart that information to other ones, and when they
That's
come
right.
on. So I think there's a lot to be said for, having someone that understands the industry really, really well. Hey, explain that travel, because I always is there's like I forgot exactly how it's put, but I mean, I have heard like there's a Thursday to Monday or a travel rule that where maybe if you schedule a travel, over the
Conference or
weekend,
something like that. Yeah.
yeah, like can you do some? I mean, you probably can't write off everything that you're doing on the weekend, but I
Yeah.
mean, if you structure it correctly, I mean, is that on the up and up?
It is because you can deduct the cost of travel to and from a location, and then the lodging for
Mm-hmm.
the business time. So let's just say you have a conference that might be on a Friday, and you have another opportunity, or maybe you have clients in a certain area, and you want
Yeah.
to travel to that area. You go out on a Thursday, your travel to and from that location's covered. Your lodging for the business days are covered. You spend the weekend, do your things. That's not deductible, and then maybe on Monday or Tuesday you have additional meetings, so then you can deduct the stays for those nights, and then of course your commute or travel back is deductible. So you can take a trip, work in some pleasure in the middle, and have at least the travel to and from taken care of, and a couple of the nights, maybe again not all of them, covered.
Mm-hmm.
So yeah, you can get a little creative with that, especially if you do the timing. I did a conference in Vegas for Thomson Reuters a while back, and it was they did two back to back, and they did the first 2 days on a Thursday, Friday, and then the second on Monday, Tuesday. So that was great for all the attendees. They were able to deduct that
Yes.
and then spend a weekend and kind of stick around if they wanted to. Now, of course, it was Vegas, and that's an expensive weekend when you go to Vegas.
Yes, it is.
But but again, things you can do that. Another one is cruises. Okay.
Mm-hmm.
Think about that. And we've talked about this a couple times. Having an event on a cruise can make a good part of that deductible. Okay. So traveling, your fees on a cruise. And that's why you see some of these real estate people doing real estate, presentations on a cruise, because then you can deduct the travel and some of the things associated with it. So you can get a little creative with that if you want.
Yeah. And then the last one I think is the renting your home out for 14 days,
The
have business
Augusta
owners.
rule.
Yeah. I mean, how, and again, a lot of this, so on the travel one, what would you have to prove to the IRS that you actually had the meetings? Like what would
Correct.
they need to see? Okay. They just need to see that they're meeting. So like if I have like a meeting in my CRM that shows, hey, I had this meeting and this meeting and this meeting, is that basically what justifies that?
Yeah. Just some sort of itinerary or
Okay.
agenda for the conference, is sufficient.
Yeah.
That's, they don't need to get real, detailed with it, but you've got to prove that you conducted business on those days somehow.
Yeah.
And generally some sort of schedule is good. So talking about the Augusta rule, the 14-day rental of your home. So it's called the Augusta rule. Do you know why?
Well, I think it's because people that have homes on the Augusta golf course that are charging like $20,000 a night, and they don't have to pay a lick of tax on that money.
Yeah, it was tied to the Masters, right? People would have their houses near the Masters tournament, and people would rent them out. And so the IRS, in kind of a rare stroke of being gracious, I guess, allowed people to rent their homes for up to 14 days and not claim the income on that. So with that, you can take that and apply it in some other fashion. So you as a business owner, if you wanted to rent your house out and have a company party or company meeting at your house, you can pay yourself from the business what would be considered a reasonable rate to rent your space in your market, and you don't have to claim that. Plus, you get the business expense deduction. So the business gets to deduct the amount that it pays you. You, as a kind of renter or lessor of that space, gets the income, and normally you would have to claim that on your income tax return. But because of this 14-day rule, you don't have to if you do it 14 days or less, and you document that it was done for a business purpose. And so, the question becomes, do you want to rent your house out to strangers or people that work for you? That's another discussion, but you can do it, and certainly it can be beneficial. What we recommend that if you're going to do that, make sure you call around and find out what like hotels are charging for event space, and you use that as your rate, and you can do that deduction. So, pretty neat little rule. Again, a rare stroke of the IRS being gracious and allowing you to do something that normally they would, want to charge you on.
Is there like a amount per day where you're just like, I mean, somebody's taking like $5,000 and it's like, that's probably not going to fly. I mean, is there a threshold? You're like, okay, $1,000 a day, 1,500. I don't know. Or does it just matter? Does it just depend upon what the other, you calling around and finding out what these other venues would charge?
Yeah. So if I'm in Cleveland, Ohio, my rate's going to be way different than if I was in New York City. Right. Okay. So it depends on the location. And so the best thing to do is call around to hotels in your area and ask them what they charge for day rates for meeting space, and be somewhere close to that. Okay. You don't have to be at or, below it. You can be above it a little bit as long as you're not way above it. So as long as you're in that range, and I, what I tell people is to substantiate it, call a couple different places, and they could be nicer places, and just find out what their day rate is. If you want to have an office meeting at your place from 8 to 5, what would you charge us for the room, and what would that look like? And so you can charge a similar thing for that.
I love it. All right. That was great, man. So people want to connect with you. How do they do it, Mark?
Yeah. So we take clients all across the country. So know that we can do that. We have a website. It's bizadvisory.com, and that's Advisory, ADVISORY.com. If you go to our homepage, there is a link there to set an appointment with us, so you can do that. We have you watch a little video that talks a little bit about what we do and how we do things, and then from there you give us some information, and you would be meeting with me to talk about, what we might be able to do for you. So we love to work with practice owners.
Yeah, for sure. And I just want to mention that one thing, because I've had this, and we'll end off on this, but this is, I think, a really good point, because people have like, well, I have a local guy and I like having a local person, and I do understand that. But, when it comes to the things that we do, proximity it really doesn't matter. I mean, you can be in Anchorage, Alaska. I'm going to give you the same quality of advice, and it's not really that difficult to change CPAs, right? I mean, what data do you need to really? I mean, you'll need their tax returns,
prior
right?
year
That's
tax
it.
return, and
I mean, is there any other data you would need?
Yeah, access to their accounting records and prior year tax return. We do have clients all over the country. I have one client that I advise that's in Portugal. Okay, so I think there's one thing we've learned the last several years is doing this online is easy. Okay, we can have a meeting and we can have a very good quality planning meeting face to face, and you don't have to be sitting in my office to do that. So, a lot of our clients are based in other states, and we do a tax return for pretty much every state in the country because we have clients all over the country, and so you may have some nuances within your state. We know and understand that. We know and understand how to deal with it, and we have access to kind of resources where we don't have that information, but for the most part, we can handle anybody anywhere, and it's not an issue.
Yeah. Don't worry about proximity. Look for competency. And
Correct.
That's much more important when you're dealing with your team. Absolutely. All right. Well, thank you again, Mark. And we'll see you guys on the next podcast. And I think that's it. So,
Eric, always a pleasure, man. I appreciate everything you guys do.
Yeah. Yeah, man. Thank you very much.
Okay. Take care.